There is a ghost in the machine of modern finance, a relentless pressure, a whisper in the ear of every investor that says, "Do something." It's the flicker of the stock ticker, the breathless headline on a financial news network, the friendly email from your broker suggesting a new, exciting opportunity. The entire architecture of the financial world is built on a single, seductive lie: that activity equals progress. That motion equals results. Wall Street has built its cathedrals of glass and steel on this premise. They want you to trade. They want you to switch funds. They want you to react. Because every time you do, a small fee is paid, a commission is generated, and the great engine of finance takes its cut. Your activity is their business model. But what if the greatest secret to building generational wealth, the kind of wealth that reshapes your family's future, isn't found in this frantic activity? What if the most powerful move you can make, for months and even years at a time, is no move at all? This is the central paradox and the profound genius of Warren Buffett's entire philosophy. He didn't build the fortress of Berkshire Hathaway by being the fastest trader or the most active portfolio manager. He built it by practicing a discipline so alien to the modern world that he himself described it as lethargy bordering on sloth. This isn't laziness. It is a strategic weapon. It is a conscious, deliberate, and deeply powerful form of inaction. It is the understanding that in the game of long-term investing, your greatest enemy is not a bear market or a recession. It is your own innate, deeply human urge to constantly do something. This is a manifesto for that powerful inactivity. It is a guide to reprogramming your financial mind, to silencing the noise, and to harnessing the one force that truly builds fortunes, the unstoppable, silent power of uninterrupted compounding. We are about to deconstruct the operating system of the world's greatest investor, and it begins with understanding the fortress he built not with frantic action, but with profound, intelligent, and profitable patience. Our journey begins with the foundational pillar of Buffett's entire system, the very bedrock upon which his empire of capital was constructed. It is the idea of the fortress of inaction, a deliberate and strategic withdrawal from the battlefield of daily market noise. To the outside world, it looks like sloth. To the master investor, it is the highest form of discipline. It is a conscious rebellion against one of the most powerful and destructive forces in human psychology, the action bias. To truly grasp this, we must travel back in time, not to a boardroom in Omaha, but to a moment of sheer panic and crisis in the heart of American finance, a moment that would test a young Warren Buffett and forge this principle in the crucible of fear. The year is 1963. The world is a very different place. John F. Kennedy is in the White House, the Beatles are about to invade America, and the financial markets are about to be rocked by a scandal so bizarre, so utterly strange, it sounds like something out of a pulp novel. It became known as the Salad Oil Scandal. The story centers on a company called Allied Crude Vegetable Oil Refining Corporation, run by a man named Anthony Tino DeAngelis. Tino was a master of deception. His company was supposed to be storing vast quantities of salad oil in giant tanks in Bayonne, New Jersey. This oil was used as collateral for massive loans from some of the biggest and most respected financial institutions on Wall Street, including a subsidiary of American Express. American Express at the time was seen as the epitome of financial solidity. Its travelers' checks were as good as gold, a symbol of trust and security the world over. Their warehousing division was in the business of certifying that the collateral, in this case the salad oil, was actually in the tanks. But Tino had a secret. Most of the salad oil didn't exist. He had devised an ingenious system. The tanks were mostly filled with water, with only a few feet of oil floating on top. When inspectors would dip their measuring sticks into the tanks, they'd hit oil at the top and assume the entire tank was full. It was a simple, brutally effective fraud. In November of 1963, the House of Cards collapsed. Tino's company filed for bankruptcy, and the truth came out. Wall Street was thunderstruck. The big reveal was that American Express, through its warehousing subsidiary, could be on the hook for over $100 million in losses. a catastrophic sum at the time that threatened to wipe out the company's entire net worth. Panic erupted. The stock of American Express, a blue-chip darling, began to plummet. It was a bloodbath. The narrative on Wall Street was clear. American Express was finished. The liabilities from the fraud were an anchor that would drag the entire company to the bottom of the ocean. The herd was stampeding for the exits. Sell, sell, sell. Every financial analyst, every talking head, every broker was screaming to get out. To hold on to the stock was to be a fool, to stand in front of a speeding train. This is the moment where the action bias kicks in with the force of a hurricane. The human brain, in the face of fear and uncertainty, screams for action. Selling the stock provides immediate relief. It makes you feel like you've taken control, that you've done something to protect yourself from further harm. Doing nothing, just holding the stock as it falls day after day, feels like a form of self-torture. But in Omaha, Nebraska, 33-year-old Warren Buffett saw not a crisis but an opportunity of a lifetime. He did not react to the noise. He did not listen to the panic. Instead, he did something entirely different. He began a period of intense, focused activity, not of trading, but of investigation. This is the crucial distinction. Buffett's lethargy applies to transactions, not to thinking. He went to work. He started visiting restaurants and banks. He spoke with merchants. He stood on street corners and observed customers. He wasn't looking at the stock ticker. He was trying to answer a single fundamental question. Had the salad oil scandal damaged the core business of American Express? Did people stop using their traveler's checks? Did merchants stop accepting their credit cards? He discovered that the underlying business, the powerful consumer brand that lived in the minds of millions, was completely untouched by the warehousing fiasco in New Jersey. People were still using their Amex cards. Travelers still trusted the traveler's checks. The scandal was a headline, a terrifying one for Wall Street, but it was largely irrelevant to the actual source of American Express's long-term earning power. He concluded that the market, in its panic, was throwing away a Rembrandt for the price of a Velvet Elvis painting. He saw that the company's fundamental value was intact, while its price was being destroyed by fear. So what did he do? He acted. But he acted once, and with enormous conviction. He instructed his partners at the Buffett Partnership to invest 40% of the partnership's entire capital into the shares of American Express. 40%. This wasn't a small speculative bet. This was an all-in move, the kind of decision that defines a career. It was the culmination of his research, a single, decisive strike. And then came the hard part. The most important part. He did nothing. He sat on his hands. The stock didn't immediately rocket upwards. The fear didn't instantly vanish. The Wall Street narrative didn't change overnight. For months, he simply held on, practicing a profound and disciplined inactivity, while the market writhed in turmoil. He had built his fortress. He had done the work, made his decision, and now his job was to let the thesis play out, to be patient, while the gap between the market price and the intrinsic value inevitably closed. Over the next few years, it did. The market eventually realized that American Express was not going bankrupt. The stock recovered and then soared. Buffett's single decisive action, followed by years of deliberate inaction, netted his partnership a fortune. It was a masterclass in separating the temporary noise from the permanent reality of a business, and it perfectly illustrates the principle that superior investing is not about constant motion, but about rare, well-thought-out action followed by disciplined, sloth-like patience. This entire episode is a living illustration of the battle against a deep-seated flaw in our mental software, the underlying psychological principle known as the action bias. This cognitive bias is the innate human tendency to favor action over inaction, even when there is no rational evidence that taking action will lead to a better outcome. In fact, we often prefer to act even if it's counterproductive, simply because the feeling of doing something is more psychologically comforting than the feeling of doing nothing. To understand why this bias is so powerful, we have to look back at our evolutionary history. Imagine our ancient ancestors on the plains of the Serengeti. They hear a rustle in the tall grass. They have two choices. They can do something, run, throw a spear, shout, or they can do nothing, stay still and observe. If they choose action and it turns out to be a lion, they survive. If it turns out to be just the wind, they've wasted a little energy, but they're still alive. If they choose inaction and it's a lion, they get eaten. The cost of mistaken inaction was death. The cost of mistaken action was minimal. Evolution, through millions of years of natural selection, hardwired a preference for action into our brains. In a dangerous, primitive world, do something was an excellent survival heuristic. The problem is that we now live in a world for which that software is woefully outdated. The stock market is not the Serengeti. The rustle in the grass is not a predator. It's a headline on Bloomberg, a tweet from an analyst, a momentary dip in a stock chart. Our prehistoric brain, however, still screams the same command: do something. When your portfolio drops 10%, your amygdala, the fear center of your brain, lights up. It doesn't know the difference between a financial threat and a physical one. It tells you to run, to sell, to act, now. This urge is compounded by another powerful psychological force: the illusion of control. We believe that by taking action, we are exerting control over an uncertain situation. Selling a stock during a downturn feels like you're grabbing the steering wheel of a car that's skidding. In reality, you're often just locking the brakes and ensuring you crash. The very act of selling crystallizes a paper loss into a real one, and it robs you of the chance to participate in the eventual recovery. Buffett's genius is his ability to consciously override this primal programming. He understands that in the world of long-term investing and asset management, the rules of the Serengeti are reversed. Here, mistaken action is often far more costly than mistaken inaction. Churning your portfolio, selling in a panic, buying into a fad. These are the lions of the modern financial jungle, and they will devour your capital. So how can we, as ordinary individuals seeking financial independence, apply this principle? How do we build our own fortress of inaction? This requires an applied mental model, a practical blueprint for behavior. Let's call it the sit on your hands protocol. It consists of 4 concrete steps. First, you must create an action firewall. This is a pre-written checklist of conditions that absolutely must be met before you are allowed to make any buy or sell decision. For a buy decision, this might include things like, I have read the last 5 annual reports. I can explain the business model to a 10-year-old. The company has a consistent track record of profitability, and it is trading at a significant discount to my conservative estimate of its intrinsic value. For a sell decision, the checklist might be, has the fundamental long-term story of the business been permanently impaired? Notice what is not on this list. The stock price went down, or a TV analyst said something negative. This firewall forces logic to precede action. Second, schedule your ignorance. The constant stream of financial information is the fuel for the action bias. The solution is to go on an information diet. Schedule specific, infrequent times to review your portfolio. For a true long-term investor, once a quarter is more than enough. Some of the greatest investors only look at their holdings once or twice a year. Outside of these scheduled times, you are forbidden from looking. Delete the stock market app from your phone's home screen. Unsubscribe from market update emails. This creates a space for patience to grow by starving the anxiety that feeds the action bias. Third, write it down. For every single investment you make, you must write down, on a physical piece of paper, a 1-page summary of your thesis. Why did you buy this company? What do you expect it to do over the next 10 years? Store this piece of paper somewhere safe. From this point forward, you are only allowed to sell if the core reasoning on that piece of paper has been proven definitively and permanently wrong. You are not allowed to sell because the stock is down 20%, or because you've gotten bored, or because you found something new and shiny. This document becomes your anchor of rationality in a sea of emotion. Finally, practice strategic boredom. Train your mind to be comfortable with doing nothing. This could be through mindfulness meditation, where you learn to observe your thoughts and urges without acting on them. It could be by cultivating a hobby that has nothing to do with finance. The goal is to decouple your sense of self-worth and your need for stimulation from the performance of your portfolio. Your investments are like a bar of soap. The more you handle them, the smaller they get. The goal of this protocol is to turn inactivity from a passive state of neglect into an active, strategic choice. Now let's look at the opposite path, the path of the 99%, the antithesis of the Buffett approach. This is the path of the hyperactive investor, a person who is not an investor at all, but a speculator held captive by the action bias. Their day begins with the opening bell on CNBC. Their mood rises and falls with the green and red arrows on the screen. They have multiple brokerage accounts, perhaps one for their serious retirement planning and another on a zero-commission app for fun trading. They are subscribed to a half-dozen newsletters, each promising the next hot stock. Their strategy is a chaotic mix of headlines, tips from friends, and gut feelings. When a stock they own goes up, they feel a rush, a dopamine hit that is biochemically similar to the thrill of gambling. This reinforces their behavior. When a stock goes down, the primitive fear circuit kicks in, and the urge to do something becomes overwhelming. They sell to cut their losses, often right at the point of maximum pessimism, just before a rebound. They see a new technology or a new trend, AI, electric vehicles, crypto, and they feel an intense fear of missing out, or FOMO. They pile in, usually after prices have already been bid up to astronomical levels, with no understanding of the underlying business or technology. Their portfolio is a revolving door of transactions. They are constantly rebalancing, taking profits, and reallocating capital. In reality, they are just churning. They are the financial industry's perfect customer. They are running on a treadmill, generating fees and taxes with every step, but ultimately going nowhere. They believe their constant activity is a sign of their engagement and sophistication. In reality, it is the clear signature of an amateur, a gambler destined to underperform and never reach true financial freedom. The financial consequences of this behavior are not abstract, they are devastatingly concrete and can be traced directly to the bottom line of an investment portfolio. Let's quantify the direct financial connection. Imagine two investors, both starting their journey towards retirement planning with $100,000 on the same day. Investor A is the hyperactive trader. Investor B is the practitioner of strategic inactivity. Investor A, driven by the action bias, makes 20 trades a year. They sell losers quickly and trim winners. Each trade incurs a small commission, and more importantly, if held for less than a year, the profits are taxed at the higher short-term capital gains rate. Let's say their frantic activity allows them to generate a gross return of 9% per year before costs. But after subtracting trading fees, higher taxes, and the inevitable behavioral mistakes, like selling during the 2020 COVID crash and buying back in much later, their actual net return is closer to 5%. Investor B, on the other hand, uses their $100,000 to buy a low-cost, broad-market index fund, a perfect vehicle for a buy-and-hold strategy. They make one transaction. Then, for the next 20 years, they do absolutely nothing. They don't watch the news. They don't check the price. They just let the great companies of the world do their work. Their investment also grows at the market's historical average, let's say 9% per year. Because they never sell, they incur no trading fees, and they defer all capital gains taxes. Their only cost is the tiny expense ratio of the fund, perhaps 0.04%. So their net return is effectively 8.96%. After 20 years, the difference is staggering. Investor A, the active trader, would have turned their $100,000 into roughly $265,000. It's a gain, but a deeply disappointing one. Investor B, the one who practiced lethargy bordering on sloth, would see their initial investment grow to over $557,000, more than double. The $500,000 portfolio versus the $250,000 one. The difference, nearly $300,000, is the direct, quantifiable financial cost of activity. It is the wealth that was transferred from the investor to brokers, fund managers, and the government, all because of the primal, irrational, and deeply expensive urge to simply do something. This is the mathematical proof of Buffett's wisdom. The fortress of inaction is not just a psychological shield, it is a powerful engine for wealth creation. To truly build this fortress, however, requires more than just resisting the urge to act. It requires a fundamental shift in how you view the act of investing itself. This brings us to our second pillar, the punch card philosophy. This is not just a catchy analogy. It is a powerful mental model that serves as the internal governor on Buffett's decision-making engine. It's the mechanism that transforms the general desire for inactivity into a rigorous, disciplined practice. It forces a level of selectivity so extreme that it makes inaction the natural default state. Imagine, as Warren Buffett has famously proposed, that when you are born, you are given a punch card with only 20 slots on it. Each time you make an investment decision in your entire life, you have to punch one of those slots. Once you've used up all 20 punches, you can't make any more investments. Think about the profound psychological effect this constraint would have on your behavior. Would you use one of your precious 20 slots on a speculative tip you heard from your brother-in-law? Would you punch your card for a stock that's hot this week but whose business you don't truly understand? Of course not. You would treat each decision with the gravity it deserves. You would do enormous amounts of research. You would wait patiently for an opportunity that was so compelling, so overwhelmingly obvious that you were willing to commit one of your life's finite allotment of decisions to it. Each punch would be the result of deep conviction. This mental model forces you to raise the bar for every decision to an almost impossibly high level. A perfect illustration of this philosophy in action is Buffett's investment in the Washington Post Company back in 1973. This wasn't a casual purchase. It was a definitive punch on his card. At the time, the market was in a sour mood. The Nifty 50 growth stocks had just collapsed, and general market sentiment was terrible. The Washington Post itself was facing skepticism. While it was gaining journalistic prestige for its Watergate reporting, its financial performance was seen as mediocre, and it was facing new competition. The stock was cheap. In fact, the entire market capitalization of the company was about $80 million. Buffett, however, did his homework. He didn't just look at the numbers, he dug deep to understand the essence of the business. He recognized that a dominant city newspaper was a natural monopoly. In an era before the internet, if you were a big department store in Washington, D.C., and you wanted to reach the entire city with an advertisement, you had one choice: the Washington Post. This gave the company tremendous, durable pricing power. It was a commercial fortress, what he would later call a deep moat. He also saw the immense value of its brand and the integrity of its management, led by Katharine Graham. He realized that the market was valuing the entire company at $80 million, when just one of its properties, the local television station, was likely worth more than that by itself. You were getting the newspaper, Newsweek magazine, and other assets for free. This was not a 50-50 proposition. This was, in his words, a no-brainer. It was an opportunity so compelling that it was worth one of his 20 punches, so he invested about $10 million, buying up a significant stake in the company. And then, true to form, he did what he does best. He held. He didn't just hold for a year or two. He held for decades. He joined the board of directors. He became a friend and advisor to K. Graham. He treated his stock purchase not as a flickering quote on a screen, but as an ownership stake in a wonderful business. That $10 million investment, that single punch on his card, would eventually grow to be worth over $1 billion. It is a testament to the power of the punch card philosophy. Conduct extreme due diligence, wait for the perfect pitch, swing hard once, and then sit back and let the power of the business do the work for you for the next 30 years. It redefines the job of an investor from a frantic trader to a patient capital allocator, a connoisseur of rare and exceptional businesses. The psychological principle underpinning the punch card philosophy is a defense against two of the modern world's most insidious mental traps: decision fatigue and the paradox of choice. Decision fatigue is a well-documented psychological phenomenon the quality of our decisions deteriorates as we are forced to make more of them over the course of a day. It's why judges are more likely to grant parole in the morning than in the afternoon, and why you're more likely to buy a candy bar at the checkout aisle after a long grocery shopping trip. Each decision, no matter how small, depletes a finite reserve of mental energy. An investor who is constantly monitoring the market, evaluating hundreds of stocks, and making dozens of trades is perpetually in a state of decision fatigue. Their later decisions are almost guaranteed to be of lower quality than their earlier ones. They become impulsive, risk-averse, and prone to simple heuristics rather than deep analysis. Buffett's punch card is a brilliant system for preserving his mental energy. By refusing to even consider 99.9% of opportunities, he saves his cognitive firepower for the few decisions that truly matter. He is always making his first decision of the day, even if it takes him a year to find it. This is closely related to the paradox of choice, a concept popularized by psychologist Barry Schwartz. The traditional view is that more choice is always better. But Schwartz's research shows the opposite. When presented with too many options, people often become paralyzed, unable to choose at all. And if they do manage to make a choice, they are often less satisfied with it, plagued by the thought that one of the other options might have been better. The modern stock market is the ultimate paradox of choice. There are thousands of publicly traded companies, thousands more mutual funds and ETFs. It is an ocean of overwhelming options. An investor without a strict filtering mechanism is doomed to be tossed about in this ocean, perpetually anxious and prone to making suboptimal choices. The punch card philosophy, combined with its practical application, acts as that essential filter. The applied mental model that brings the punch card philosophy to life is what Charlie Munger, Buffett's longtime partner, calls the circle of competence. This is the blueprint for its execution. The first step is to define your own circle of competence with brutal, unflinching honesty. This is not about what you want to know, or what sounds exciting. It's about what you already, genuinely understand on a deep level. Perhaps your career is in software engineering, so you have a real-world, ground-level understanding of enterprise software companies. That's in your circle. Perhaps you've been a lifelong obsessive consumer of a particular brand of consumer goods, and you understand its competitive position intimately. That's in your circle. Banking, insurance, biotechnology, mining. If you don't understand the fundamentals of the industry, it is outside your circle. You must write this down. Create a clear boundary. The second step, and this is crucial, is to create what Munger calls a too-hard pile. Every investment idea you encounter, from a news article, a friend, an analyst report, must first pass through this filter. Is it within your circle of competence? If the answer is no, it immediately goes into the too-hard pile. You don't spend another second thinking about it. No exceptions. This one simple habit will eliminate over 99% of all investment opportunities, instantly freeing you from the paradox of choice and preserving your mental energy. For the few ideas that do fall within your circle, you then apply a final, unforgiving quality checklist. This is where you raise the bar to punch card level. Your checklist should include questions like, does this business have a durable competitive advantage, a deep moat that protects it from competitors? Is the management team both talented and honest? Can I understand how this business will be making money 10 or 20 years from now? Is it trading at a price that offers a significant margin of safety below my conservative estimate of its value? An investment idea must get a resounding yes to every single question. It's not about finding reasons to invest. The default is not investing. Your job is to find a single definitive reason to say no. Only the truly rare, extraordinary opportunity that survives this gauntlet is worthy of one of your 20 punches. Now let's examine the antithesis, the path walked by the vast majority of individual investors. This is the path of what Peter Lynch called diversification. It's the trap of the person who believes that diversification means owning as many different things as possible. Their portfolio is a chaotic collection of dozens, sometimes hundreds of stocks. They own a bit of this tech company, a piece of that industrial giant, a few shares of a pharmaceutical startup they read about online. They have no deep knowledge of any of these businesses. Their strategy is to spread their bets so widely that no single failure can hurt them too badly. But the flip side is that no single success can help them very much either. They have assembled a portfolio designed for guaranteed mediocrity. This investor is punching their card every week. They are constantly adding new positions, chasing new stories. Their justification is diversification, but it is a twisted, ineffective form of it. True diversification is not about how many things you own. It's about owning a collection of assets whose long-term business fates are not highly correlated. Owning 100 different speculative tech stocks is not diversification. The diversifier has an enormous monitoring cost. They cannot possibly keep up with the quarterly reports and competitive dynamics of all the companies they own. So they don't. They end up tracking the only thing they can easily see: the daily stock price. This makes them highly susceptible to the action bias and market noise we discussed earlier. They lack the conviction that comes from deep knowledge, so they are easily shaken out of their positions during downturns. They are the opposite of the punch card investor. They are a collector of lottery tickets, hoping one will pay off, instead of a focused owner of a few great businesses. This is a common failure in personal portfolio management, and it's a surefire path to disappointing long-term results. The direct financial connection between the punch card philosophy and building wealth is found in the power of concentration. By forcing you to make fewer, better decisions, this philosophy naturally leads you to own a more concentrated portfolio of your absolute best ideas. While modern portfolio theory often preaches broad diversification, the truth is that no one ever got truly rich by owning a tiny piece of everything. The great fortunes, from Buffett's to those of the great four entrepreneurs, were built on concentrated bets in businesses they understood deeply. Let's use a simple numerical example. Investor A, the diversifier, has a $100,000 portfolio spread across 50 different stocks, with $2,000 in each. Investor B, the punch card investor, has their $100,000 concentrated in just 5 high-conviction ideas, with $20,000 in each. Now let's say both investors are skilled enough to find one truly spectacular company, a 10-bagger, that increases in value by 10 times over the next decade. For Investor A, their $2,000 position grows to $20,000. It's a great return on that one stock, but it only adds $18,000 to their total portfolio value. Their overall portfolio grows, but the impact of their single best idea is heavily diluted. For Investor B, their $20,000 position in that same company grows to $200,000. This one single brilliant decision adds $180,000 to their portfolio. It completely transforms their financial situation. The punch card philosophy is not just about avoiding mistakes. It's about ensuring that when you are right, you are very, very right, and that it makes a meaningful difference to your net worth. It's the difference between building a modest nest egg and creating true generational wealth. It is the engine that drives returns from average to extraordinary. However, even with the right mindset and the most selective decision-making process, there is a silent killer of wealth that stalks every investor. It is an enemy that thrives on activity and is relentlessly promoted by the very industry that claims to be helping you. This brings us to our third pillar, the enemy within, frictional costs and the tyranny of fees. This is where the argument for inactivity moves from the realm of psychology to the cold, hard reality of mathematics. Every unnecessary action you take in your portfolio is like a small leak in a giant tank. Individually, the drips seem insignificant. But over the long arc of an investing lifetime, they can drain away a shocking percentage of your potential wealth. There is no more powerful or public demonstration of this principle than Warren Buffett's famous 10-year bet against the hedge fund industry. The story is a masterpiece of public education, a real-world, high-stakes experiment that pitted the philosophy of passive, inactive, low-cost investing against the best and brightest of the high-fee, hyperactive world of Wall Street. The stage was set in 2007. Buffett made a public wager, offering to bet $500,000 that over a 10-year period, a simple, unmanaged, low-cost S&P 500 index fund would outperform a portfolio of hedge funds chosen by a professional investment manager. He argued that the high fees charged by hedge funds would act as a devastating anchor on their performance over the long run. For a long time, no one took the bet. It was a direct challenge to the entire mystique of Wall Street's smart money. Finally, a firm called Protégé Partners, a specialist in investing in hedge funds, stepped up. They selected 5 different funds of funds, meaning each of the 5 funds, in turn, invested in a portfolio of individual hedge funds. This was the supposed pinnacle of sophisticated asset management, a curated collection of the most brilliant financial minds in the world. The bet began on January 1, 2008, just as the global financial crisis was about to unfold. The terms were simple. Buffett's pick was the Vanguard S&P 500 Admiral Fund, a basic index fund with minuscule annual fees. Protégé's 5 funds of funds were actively managed, employing complex strategies and, most importantly, charging complex and heavy layers of fees. There was the typical 2 and 20 inches structure, where the hedge fund manager takes a 2% management fee off all assets each year, plus 20% of any profits. On top of that, the fund of funds itself charged its own layer of fees for the service of selecting the underlying hedge funds. The total annual costs for the hedge fund portfolio were immense. Over the next 10 years, Buffett would periodically update Berkshire Hathaway shareholders on the bet's progress in his annual letters. For the first few years, during the depths of the crisis, the hedge funds did slightly better, as their strategies offered some protection in a falling market. But as the market began its long, slow recovery, the immutable law of costs began to assert itself. The S&P 500, with its tiny fee drag, started to pull ahead. The hedge funds, for all their supposed genius and frenetic trading, were like a world-class runner trying to win a marathon while carrying a 50-pound backpack. The sheer weight of their fees was too much to overcome. The final results at the end of 2017 were not just a win for Buffett, they were a complete and utter rout. Over the 10-year period, the simple, inactive S&P 500 index fund had an average annual return of 7.1%. The 5 funds of funds, supposedly managed by the best in the business, had an average annual return of only 2.2%. The low-cost, do-nothing approach didn't just win, it annihilated the high-cost, do-everything approach. A $1 million investment in the index fund would have grown to over $854,000 after 10 years. The same investment in the hedge funds would have grown to only $220,000. Buffett's point was proven in the most dramatic way possible. The greatest enemy for the hedge fund investors wasn't a bad market. It was the enemy within. The corrosive, relentless, and wealth-destroying power of fees, the direct byproduct of an industry built on the myth of activity. The psychological reason we are so vulnerable to this tyranny of fees is a cognitive bias you could call inattentional blindness to compounding costs. We are psychologically wired to underestimate the long-term impact of small, recurring numbers. A 2% annual management fee doesn't sound like a lot. It seems like a small price to pay for professional financial advisory or for access to a genius fund manager. We see the big, flashy number, the fund's gross return, and our attention is drawn to it. The small, persistent fee is like the famous invisible gorilla in the psychology experiment. We are so focused on watching the basketball players, the returns, that we fail to see the man in the gorilla suit walking through the middle of the scene, the fees. This bias is exploited by the financial industry. They market their performance in gross terms. Before fees are deducted, they emphasize short-term outperformance. They create an illusion of value that justifies the high costs. But the math of compounding works on costs just as powerfully as it works on returns, only in reverse. A 2% fee isn't just 2% of your capital this year. It's 2% of your capital, plus 2% of the returns you would have earned on that capital, every single year, for the rest of your life. Over an investing lifetime of 30 or 40 years, this seemingly small percentage doesn't just take a piece of your returns, it can consume more than half of your entire potential nest egg. Our inability to intuitively grasp this exponential destruction is a cognitive blind spot that costs investors trillions of dollars. To combat this, you need a practical tool, an applied mental model to make the invisible visible. Let's call it the frictional cost audit. This is a step-by-step process every person should conduct on their investments at least once a year. Step 1 is to gather your statements for all your investment accounts, your 401k, your IRA, your brokerage accounts. Step 2 is to become a fee detective. For every single fund, ETF, or product you own, you must identify every single associated cost. This includes the expense ratio, management fees, advisory fees if you use a financial advisor, trading commissions, 12b-1 fees, and any other administrative costs. You may have to dig into the fund's prospectus document to find all of them. Step 3 is the moment of truth. You take these numbers and plug them into a compounding cost calculator, which are readily available for free online. You input your current investment amount, your expected rate of return, and the total percentage of fees you are paying. Then you project the impact over 10, 20, and 30 years. The results will shock you. You will see a clear, unambiguous number representing the total amount of your future wealth that will be transferred from your pocket to the pockets of financial companies. This exercise pierces through the inattentional blindness. It makes the gorilla visible. Step 4 is to take action based on this audit. Create a concrete plan to migrate your assets towards lower-cost alternatives. In most cases, this will mean moving from actively managed mutual funds with high expense ratios to broad market passive index funds or ETFs. These instruments are the embodiment of the inactive philosophy. They don't try to outsmart the market. They aim to be the market at the lowest possible cost. By conducting this audit, you are taking direct control of one of the most important variables in your long-term financial success. The antithesis of this approach is the path of the 99%, which can be described as the seduction of the star fund manager. This is the investor who is perpetually chasing performance. They look at the Morningstar ratings or a top funds of the year list and pour their money into whatever fund has had the best returns over the past 1 to 3 years. They are drawn in by the compelling story of a genius manager, a guru who has the secret sauce to beat the market. They willingly pay high fees, like the 2% management fee and 20% of profits common in the private equity and hedge fund world, because they believe they are paying for access to this rare talent. What they fail to understand is a powerful statistical concept called reversion to the mean. In finance, as in many parts of life, extreme performance is often followed by average performance. A fund manager who has an incredible 3-year run is more likely to be lucky than skilled. The odds that they will continue to outperform the market over the next 10 or 20 years are incredibly small. Countless studies have shown that the vast majority of actively managed funds fail to beat their benchmark index over the long run, especially after their high fees are taken into account. The investor who chases these stars is constantly buying in after the great performance has already happened, paying a premium for past glory. They are stuck in a cycle of buying high, being disappointed by average or below average returns, and then selling to chase the next new hotshot. It is a game designed for them to lose, where the only guaranteed winners are the fund companies collecting the fees. This is the core business model of a huge segment of the financial advisory world. The direct financial connection here is a brutal and unavoidable mathematical certainty. Let's illustrate it with a tale of 2 portfolios. Imagine 2 twin sisters, both diligent savers, who each invest $100,000 for their retirement 30 years away. Both of their chosen investments manage to earn the same gross annual return of 8%. The only difference is the fees. The first sister, let's call her Active Annie, entrusts her money to a traditional financial advisor who places her in a portfolio of actively managed mutual funds. The total annual cost, between the advisory fee and the fund expense ratios, comes to a seemingly reasonable 2%. The second sister, Passive Penny, has read about Buffett's bet. She invests her money in a simple, low-cost S&P 500 index fund with an all-in cost of just 0.05% per year. Then she forgets the password to her account for 30 years. After 30 years, they meet to compare their results. Annie, whose money has been compounding at a net rate of 6%, 8% gross return minus 2% fees, has seen her portfolio grow to $574,349. She's happy. She has more than quintupled her money. But then Penny reveals her statement. Her money, compounding at a net rate of 7.95%, 8% gross return minus 0.05% fees, has grown to $973,741. The difference is almost $400,000. It is a life-changing amount of money. Where did it go? It was silently siphoned out of Annie's account, year after year, in the form of fees. It is the direct financial price she paid for choosing the path of activity and high costs over the path of inactivity and low costs. This isn't a theoretical exercise. This is the reality for millions of investors. Frictional costs are the termites of your financial house. You may not see them, but they are working 24/7 to eat away at the foundation of your wealth, and the only way to stop them is to stop the activity on which they feed. Once you have built your fortress of inaction, learned to make decisions with extreme selectivity, and ruthlessly purged your portfolio of wealth-destroying costs, you are ready to unleash the most powerful force in the financial universe. This brings us to our fourth pillar, the compounding engine. Why your best move is no move at all. Albert Einstein is often apocryphally quoted as having called compound interest the eighth wonder of the world. Whether he said it or not, the statement is true. It is a force of nature, a mathematical certainty that can turn modest sums of capital into staggering fortunes. But it has one critical requirement. It needs time, and it needs to be left alone. Activity is the enemy of compounding. Every time you interrupt it, you reset the miracle. True lethargy, true inactivity, is about having the wisdom and the discipline to step aside and let this powerful engine do its work. For the perfect foundational anecdote of this principle, we must look at one of Buffett's most beloved and most instructive investments, See's Candies. This story is crucial because it's not about a high-flying tech company or a brilliant piece of financial engineering. It's about a simple, boring business that makes chocolates. In 1972, Warren Buffett and Charlie Munger, through their company Blue Chip Stamps, purchased See's Candies for $25 million. By all accounts, it was a wonderful business. It had a beloved brand, particularly on the West Coast, and a loyal customer base that associated its products with holidays, celebrations, and quality. The key to the See's Candies story is not the brilliance of the purchase, though it was a fair price for a great business. The key is what Buffett and Munger didn't do after they bought it. They didn't try to radically change the company. They didn't leverage it up with debt to pull out cash. They didn't try to aggressively expand it across the entire country, which might have diluted the brand's special regional appeal. And most importantly, for the next 50 years, they never, ever considered selling it. Their job as owners was one of profound inactivity. They let the business do what it did best: make delicious candy and build its brand. See's had a secret weapon: pricing power. Because customers loved the product and trusted the brand, See's could raise its prices by a little bit each year to cover inflation and increase its profits, and customers would happily pay. The business required very little new capital to operate. It was a cash-generating machine. Year after year, it produced a steady and growing stream of profits. That cash was then sent back to Omaha, where Buffett could allocate it to other investments. The numbers are simply mind-boggling. That initial $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway. $2 billion from a $25 million purchase. This didn't happen because of clever trading or complex financial maneuvers. It happened because Buffett and Munger bought a wonderful business and then did absolutely nothing but let it sit and compound its earning power for half a century. They let the magic of the business work for them. See's Candies is the ultimate testament to the idea that once you have made a great decision, the most profitable thing you can do is go on a 50-year vacation. Your best move is no move at all. It is the purest example of how long-term investing can generate incredible streams of passive income and capital growth, simply by getting out of the way. The psychological barrier that prevents most people from achieving this kind of result is a powerful cognitive bias known as hyperbolic discounting. This is our brain's tendency to have a stronger preference for smaller, more immediate rewards over larger, later rewards. The further away a reward is in the future, the more we discount its value in our minds today. This bias has deep evolutionary roots. For our distant ancestors, the future was deeply uncertain. It made perfect sense to prefer a guaranteed small meal today over the mere possibility of a larger meal next week. A bird in the hand was worth two in the bush because the bush might be empty tomorrow. This short-term preference is hardwired into our neurochemistry. Getting an immediate reward triggers a release of dopamine, the pleasure neurotransmitter in our brains. In the modern world of investing, this wiring is a catastrophic liability. The stock market provides a constant stream of potential immediate rewards. You can log into your account and see that a stock is up 5% today. Selling it and locking in the gain gives you that immediate dopamine hit. It feels good. It feels smart. The alternative, holding that same stock for 30 years in the hope of a 10,000% gain, is abstract and distant. Our brain struggles to value that far-off uncertain reward as highly as the small certain reward available right now. This is why people check their portfolios daily. It's why they sell their winners too early. They are sacrificing the life-changing fortune of tomorrow for the trivial psychological satisfaction of today. Hyperbolic discounting is the enemy of compounding. To become a great long-term investor, you must wage a conscious war against this innate impatience. The applied mental model to win this war is what can be called the owner's mindset shift. You must fundamentally change your relationship with your investments. You are not a trader renting stocks. You are an owner of businesses. This shift requires 3 practical habits. First, before you buy a single share of a company, you must perform the buy the whole company test. You write a 1 to 2 page memo to yourself as if you were a private equity investor considering buying the entire business outright. You would justify the purchase price, outline the company's long-term competitive advantages, and explain why you believe it will be more valuable in 10 years. This forces you to think like a business owner, not a gambler playing with ticker symbols. Second, you must change how you measure success. Instead of checking the daily stock price, your new habit is to ignore the price completely. Your only scheduled interaction with your investment is to read the company's quarterly and annual earnings reports. This is what a real business owner does. They review the financials, listen to the management's conference call, and assess the underlying health and progress of the business itself. Is revenue growing? Are profit margins stable or expanding? Is the company strengthening its competitive position? By focusing on business metrics, you shift your time frame from seconds to years. The daily gyrations of the stock price become irrelevant background noise. Third, you must internalize the mantra, I am a partner with the management. When the stock price falls by 20% because of a general market panic, an owner doesn't sell their great business. A true owner might even see it as an opportunity to increase their stake at a cheaper price. They have conviction in the long-term value of the enterprise. By viewing your shares as a partnership certificate in a real, ongoing business, your natural inclination will shift from frantic activity to patient, long-term observation. Inactivity becomes the logical and default choice of a committed owner. The antithesis to this owner's mindset is the dominant ethos of our time, the traded not owned phenomenon. This mindset is most visible in the generation of investors raised on zero-commission trading apps that have gamified the stock market. These platforms are designed to encourage activity. They shower users with digital confetti for making a trade. They present stock charts like video game levels. They reduce ownership to a flickering line on a smartphone screen. The person caught in this phenomenon sees stocks as nothing more than abstract instruments for short-term speculation. They buy a company on Monday morning and sell it on Tuesday afternoon because of a rumor they saw on a social media forum, or because a technical chart pattern suggested it was, quote, overbought. They are not investing in the long-term productive capacity of a business. They are betting on the short-term psychology of other bettors. They are renters of stocks, not owners. This constant churn, this hyperactive trading, makes it mathematically impossible for them to ever benefit from the true engine of wealth creation, the long-term compounding of value in an underlying business. They are so busy trying to scalp a few percentage points of profit that they miss out on the 1,000% returns that are generated over decades. They are, as the old saying goes, picking up pennies in front of a steamroller. The direct financial connection here is the breathtaking, almost spiritual power of uninterrupted compounding. Let's make the math visceral. Imagine you invest $10,000 into a single great business, a business you've identified using your punch card philosophy. And let's say this business is able to grow its intrinsic value, and by extension, its stock price, at an average rate of 15% per year. If you get impatient, if you fall prey to hyperbolic discounting and sell after 5 years to lock in a gain, your $10,000 will have grown to $20,113. You've doubled your money, it feels great, you got your dopamine hit. But what did you give up? If you had practiced disciplined inactivity, if you had simply done nothing for 30 years, that same $10,000 investment would have compounded into $662,117. Let that sink in. By selling early, you didn't just lock in a $10,000 profit, you forfeited over $640,000 of future wealth. Let's take it further. If you had the temperament to do nothing for 40 years, that initial $10,000 would become $2,678,635. This is the eighth wonder of the world. It is a force of exponential growth. But the exponential curve is fragile. Every time you sell, you break the curve. You have to pay capital gains taxes, which reduces the principal you have to reinvest. You have to find another investment that is just as good, which is incredibly difficult. You essentially reset the compounding clock back to year one. Inactivity is the guardian of the exponential curve. It is the discipline that allows the magic of compounding to achieve its full, explosive, and life-changing potential. We have now assembled the core machinery of Buffett's philosophy, a fortress of inaction to combat our worst impulses, a punch card to ensure extreme selectivity, a ruthless focus on minimizing costs, and a profound respect for the power of uninterrupted compounding. But all of this machinery is useless without a skilled and disciplined operator. This brings us to the fifth and final pillar, the element that ties everything together, the temperament of a master, cultivating patience in a world of noise. This is perhaps the most difficult and most important part of the entire equation. You can understand all the theories, you can build the most elegant spreadsheets, but if you lack the emotional fortitude to execute the strategy in the face of uncertainty and social pressure, you will fail. The ultimate foundational anecdote for the power of temperament took place during one of the wildest, most manic periods in modern financial history, the dot-com bubble of the late 1990s. It was a time when it seemed the old rules of investing no longer applied. A new paradigm had emerged. Any company with .com in its name, regardless of whether it had profits or even a coherent business plan, saw its stock price soar to unbelievable heights. It was an era of mass euphoria, a nationwide get-rich-quick frenzy. And in the middle of this raging party stood Warren Buffett, looking like a relic from a bygone era. He famously refused to invest in the high-flying tech stocks. He admitted openly that they were outside his circle of competence, that he couldn't predict which ones would be the winners in 10 or 20 years. As the Nasdaq index doubled and then doubled again, Buffett's Berkshire Hathaway, filled with old economy stocks like insurance companies and consumer brands, began to dramatically underperform the market. The pressure on him was immense. He wasn't just missing out on the party, he was being publicly ridiculed for it. The financial media, which had once revered him as a sage, now painted him as a dinosaur. The cover of Barron's magazine in 1999 infamously featured a picture of him with the headline, "What's Wrong, Warren?" The article suggested his value investing style was dead, an artifact of an industrial economy that had been replaced by the frictionless world of the internet. He was an old man who just didn't get it. The social pressure was enormous. His investors were questioning him, his reputation was on the line. The temptation to give in, to just buy a few tech stocks to quiet the critics and participate in the gains, must have been overwhelming. But Buffett's temperament, his emotional discipline, held firm. His job was not to be popular. His job was to be rational. In the summer of 1999, at a conference in Sun Valley, he gave a now legendary speech. He didn't rail against technology. Instead, he calmly used the history of other transformative industries, like airlines and automobiles, to show that while an industry can change the world, it doesn't mean that its stocks will be a good investment. He methodically explained the principles of valuation and warned that the expectations being priced into these dot-com stocks were bordering on fantasy. He was calm. He was rational. He was completely alone. And then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a catastrophic collapse. Over the next 2 years, it would fall by nearly 80%. Trillions of dollars of speculative wealth evaporated. The companies with no profits and no business plans went bankrupt. The very same people who had called Buffett a dinosaur were wiped out, and Berkshire Hathaway, with its portfolio of solid, profitable businesses, sailed through the storm. His inactivity, his refusal to participate in the mania, which had made him look like a fool in 1999, was revealed to be the highest form of wisdom in 2001. It was the ultimate triumph of temperament over trend, of rationality over mob psychology. The psychological force that Buffett was battling is one of the most powerful in the human experience, the principle of social proof and the resulting herd behavior. We are social creatures. For millennia, our survival depended on our ability to stick with the tribe. Being ostracized from the group was a death sentence. This has left us with a deep-seated psychological need to conform, to do what others are doing. When we are uncertain about the correct course of action, we look to the actions of others as a guide. This is social proof. In the financial markets, this instinct is amplified to a deafening roar. When everyone around you is getting rich, buying a certain type of stock, the fear of missing out, or FOMO, becomes an almost unbearable psychological pain. It feels like the entire herd is stampeding towards an oasis of wealth, and you are being left behind to die of thirst in the desert. The pressure to join in, to buy what everyone else is buying, is immense. This is what creates speculative bubbles. The price of an asset stops being a reflection of its underlying value and becomes purely a reflection of social mood. People are buying not because they've done the research, but simply because the price is going up and they see others getting rich. It becomes a nationwide chain letter. Buffett's true genius may not be his analytical ability, which is formidable, but his temperamental ability to completely insulate himself from this pressure. He has the capacity to stand apart from the maddening crowd, to be comfortable looking foolish, to be lonely in his conviction. This is the rarest and most valuable quality in any investor or entrepreneur. So how can we cultivate this master temperament in ourselves? It requires a conscious, applied, mental model. Let's call it the anti-news diet and stoic practice. It has 3 components. First is the information diet. You must drastically and ruthlessly curtail your consumption of short-term financial media. No more watching CNBC during the day. No more reading breathless market is up down articles. This content is not designed to inform you. It is designed to trigger your emotional responses of fear and greed, to fuel the action bias. You must replace this high-frequency, low-signal noise with low-frequency, high-signal information. Your new diet should consist of reading annual reports, industry trade journals, and deep business biographies. This is the information that builds true understanding and long-term conviction, insulating you from the daily chatter. Second, you must practice the mental tool of inversion, popularized by Charlie Munger. Instead of asking the conventional question, "How can I profit from this hot new trend?" you invert it. You ask, "How could this trend lead to mass delusion, irrationality, and the permanent destruction of capital?" By actively seeking out the bearish case, by forcing yourself to argue against your own initial enthusiasm, you build a powerful defense against overconfidence and herd behavior. Third, you must incorporate a form of Stoic practice into your mental routine. The ancient Stoic philosophers recommended a technique called negative visualization, or premeditatio malorum. You regularly and vividly imagine negative outcomes. For an investor, this means spending time, perhaps once a month, imagining a 50% market crash. Mentally rehearse it. Picture your portfolio value being cut in half. What would you do? How would you feel? Would you panic and sell everything? Or would you calmly consult your checklist and perhaps even see it as a buying opportunity? By practicing for financial crises in the calm of your own mind, you are psychologically inoculating yourself. You are training your emotional immune system. When the real crisis inevitably arrives, you will be prepared, not panicked. You will have the temperament of a master because you have practiced for the test. The antithesis of this disciplined temperament is the FOMO-driven investor. This person is the mirror image of Warren Buffett during the dot-com bubble. They are a pure creature of social proof. Their investment strategy is dictated entirely by what is popular. They see a meme stock soaring on Reddit and pile in near the top. They hear about a new cryptocurrency that is the next Bitcoin and buy it without any understanding of the technology. Their primary motivation is not a rational assessment of value, but a toxic cocktail of envy and the fear of being left behind. They are an emotional puppet, and the market is the puppeteer. When the herd is greedy, they are greedy. When the herd is fearful, they are terrified. They have no internal anchor of conviction, no written-down thesis to guide them. Their only guide is the mood of the crowd. As a result, they are destined to repeat the classic mistake of the amateur investor. They buy high, in a frenzy of excitement, and they sell low, in a fit of panic. They are the ones who provide the liquidity for the more disciplined investors. They are the ones who transfer their wealth to those with the temperament to stand apart. They are the noise from which the master investor profits. This lack of temperament has a direct and quantifiable financial cost. We can call it the volatility tax. Every time an investor makes an emotional, herd-driven decision, they are effectively imposing a tax on their own returns. The evidence for this is overwhelming. For decades, a company called Dalbar has published a famous annual study called the Quantitative Analysis of Investor Behavior. It compares the returns that investors in mutual funds actually achieve versus the returns of the mutual funds themselves. Year after year, the study shows a massive gap. The average investor dramatically underperforms the very funds they are invested in. For example, over a 20-year period, the S&P 500 might produce an average annual return of, say, 9%. But the average equity fund investor over that same period might only earn a return of 5% or 6%. That gap of 3 to 4% per year is the volatility tax. It is the direct financial penalty for bad behavior. It's the cost of chasing hot funds, panic selling during downturns, and jumping back in after the recovery has already happened. It is the price of letting fear and greed, instead of rationality and patience, drive your executive decision-making. Cultivating a master temperament, a discipline of strategic inactivity, is not just about feeling calmer, it is about eliminating this self-imposed tax. By simply avoiding these behavioral errors, by having the fortitude to sit still through the storms, you can add percentage points to your annual return. Over an investing lifetime, that difference, compounded, is the difference between a comfortable retirement and true financial independence. It is the final and perhaps greatest financial gift of a lethargy that borders on sloth. You have now journeyed through the 5 core pillars of Warren Buffett's philosophy of inactivity. You've seen how this strategic lethargy is not an absence of effort, but the highest form of financial discipline. You now possess the blueprint for a fortress of inaction to shield you from your own worst instincts. You hold the mental model of the 20-slot punch card to force you to make fewer and monumentally better decisions. You understand the silent tyranny of fees and how inactivity is the ultimate weapon against them. You have witnessed the awesome, world-altering power of an uninterrupted compounding engine, and you have been given the tools to cultivate the master temperament required to let that engine run. This is more than just a collection of tips. It is a complete operating system for rational and successful capital allocation. You have acquired a mental toolkit that the 99% of market participants will never possess. But here is the crucial distinction. Understanding why and one boy. To do nothing is a profound and powerful shield. It protects your capital from the most common and destructive errors. However, it is only one half of the complete equation. The other half, the part of the system that generates the truly extraordinary returns, is the sword. It is the initial, focused act of selection. Buffett's inactivity is so powerful only because the asterisk activity that precedes it, the process of identifying that 1 in a million business worth buying and holding forever, is so relentlessly brilliant. The patience is the amplifier, but the quality of the initial decision is the source of the signal. Knowing how to sit still is defensive genius. Knowing what to buy is offensive genius. The principles that allow you to identify a business with a truly impenetrable competitive moat. The framework for assessing the integrity and talent of its management. The precise method of calculating its intrinsic value to ensure you are buying with a margin of safety. That is the missing link. It is the knowledge that connects the profound patience you have just mastered with the extraordinary opportunity that deserves such patience. The video that is now appearing on your screen is designed to be that link. It is the next piece of the map. It bridges the why of disciplined holding with the critical what of brilliant selection. You have already demonstrated that you are not like the 99%. You are not here for hot tips or get-rich-quick schemes. You are an architect of wealth, a long-term thinker dedicated to mastering the craft of investing. The choice before you is not simply whether to watch another video. The choice is whether you are content with building a shield, or whether you will now forge the sword to complete your arsenal. The journey to becoming a true master capital allocator continues. The next step in your ascent is right there, waiting for you.